I'd expand that a little bit. So I spend an inordinate amount of time thinking about the mistakes I've made, and every day I'm making mistakes. You accept that going in. You know that you can have a really long and successful career in this business if you're only right 60% of the time. The key is that the 40% of the time that you're wrong, you can't let that destroy you. You can't let that, because real risk is it puts you out of the game. You've had such a big drawdown. You've lost your capital base. You've lost your investors. You can't continue. So, really, the focus should be on, first and foremost, on avoiding losses. Right? I remember the first time I heard the Buffett thing of the first rule is don't lose money, and the second rule is don't forget rule number one. And you think, well, that's a little hokey. And the more you're in this business, you realize, what, that really is the most important thing. It really is. Just keep the losses to the minimum. The upside, it's a growing economy. It's a growing world. The upside can take care of itself in a lot of situations, as long as you avoid, getting knocked out somewhere along the way. That's where the beauty of compounding really can take effect. So, to get back to the heart of your question, early or wrong. So, in thoroughly analyzing all the mistakes that I've made and continue to make, you look at it, or I look at it in a framework of, right or wrong. Am I correct or wrong for the right reasons or for the wrong reasons? If you are, taking a position that says, okay, I have 80%, confidence, let's say that this, will be a double, and I have 20% confidence that I might lose, 20%. That's a very attractive reward to risk. But it also means that you're accepting the fact that there is that 20% probability that you could lose 20%. So if it turns out that, you lose 15%, let's say, you have to say, well, why? Well, was it because you analyzed the situation correctly? The thing that you thought could happen, one of the outcomes you thought could happen was that downside. And if that event played out as you expected it could, and you had the outcome that you expected, then you really can't beat yourself up over that. You would take that bet again. But if it turned out that you were wrong for some other reason, and it wasn't the event that you expected that caused the downside, or the event occurred but the downside was significantly greater than you had forecast, well, then there was a cognitive error. Then you got something wrong. And I think it's also just as important to be. I'm exceptionally hard on myself with the losses and the mistakes. But what's almost harder, I think, behaviorally, is to be just as rigorously scrutinizing your wins. Did you is your track record because you had one home run and everything else was kind of mediocre, or do you have a consistent process that is churning out doubles and triples on a pretty regular basis, something that's repeatable? That's something to be proud of. If you just got lucky, if you're in a position and it wasn't working out, and you didn't have the discipline to exit because the data's changed, or you've found other reason to invalidate your thesis, and then all of a sudden, you wake up one morning and somebody has a bid in for the company, and you look brilliant, but be honest with yourself, you screwed up. You screwed up. And so I think behaviorally, that is actually the harder part. In terms of being early and wrong, it's really situational, but from the return perspective, there's there's really not much difference there, right? And you have to ask yourself, well, for what reason did this not play out?